Venture capital has endured some compression during 2022, but looking at the constant annual growth rate for the past 9 years, a slowdown has been waiting for a reason to happen. And we had quite a few reasons, from the pandemic-related disruption to supply chain problems to the Federal Reserve's interest rate, all have contributed to an increase in the cost of capital. Early stage startups encountered the most significant headwinds. PitchBook and the National Venture Capital Association published a detailed report which revealed the extent of these drops in funding activity across the board. So the question is, are startup funding terms and dynamics undergoing a reset? And are there any silver lining opportunities for startup companies in the current environment?
A downturn, though, overall is not a bad news. It certainly causes distress. It certainly will cause companies to fail. It certainly is painful. But if you look at all the great companies, most of them have actually been created in downturns. Google, very famously, aggregated a whole bunch of talent because of a downturn. PayPal survived a downturn. And look, I think there's something to be said about the PayPal mafia being so good and so connected because they survived a really very challenging environment. It made them more resilient.
My name is Jim Connor. Welcome to Game Changers Silicon Valley. My guest for this topic is Amit Garg, co-founder of Tau Ventures, who focuses on early-stage startup companies. Let's join Amit in our online call. Today, I'm so pleased to have Amit Garg of Tau Ventures join us for a robust and in-depth conversation about venture capital, what it takes to get started, and what it takes to be successful. So, Amit, welcome to the show.
Jim, thank you for having me. It's an absolute honor and a pleasure. And you and I have been collaborating for a while without realizing it. So now we get to actually collaborate.
So let's start with what you're doing at Tau. I mean, you were an entrepreneur. You went to grad school. You went to Stanford. You went to Harvard. You worked for 2 venture capital firms, and then you decided one day to say, I think I can do this on my own. I can do it better. Is that correct?
Well, yes, I guess a little bit of arrogance there in me saying this, but yes, I do believe I can do what I'm doing better than working for someone. Otherwise, I wouldn't have started the fund. There's plenty of amazing VC funds out there, so that's not to say that we will be better than all of them. But what we want to do is to provide a very unique value in how we invest, in what we invest in. We're focused on AI investments in healthcare and in enterprise. And we're bringing everything that we have learned in our careers, we have done in our careers to the table here. And we are proud today of where we are. There's a lot more to be done, but I feel that I can say with some degree of humility that we've at least done the first step correctly. We have 44 companies today. We have 86 million total that we are managing. We have had 4 exits. We, as literally an hour ago, sent out our end of year review, since this is being recorded December 29th, 2022. And we enumerated a bunch of things that we have done. And the key lesson for me is that you build this continuously forward. So my hope, my goal, my plan is to continue building Tau as long as I can.
So one of the things that's impressive to me or notable is that you have been an entrepreneur. You did a startup, you went through the process, you raised some money, the startup's been doing well, continuing to grow. Has that given you unique insights into making judgments about the right entrepreneur team? I'm going to make the assumption that your experience in the startup has given you some unique insights.
Well, that's very kind of you, Jim. I don't know if I would say absolutely unique because I've been meeting more and more founders turned investors. It may still be a minority, but it's not a minority of one. But I do think that it gives you a very differentiated perspective because you speak from a place of experience. And in my case, I was an operator before all of that. So I joined Google pre-IPO days when it was a much smaller company. It was, you could argue it wasn't a startup per se. It was a very successful private company at that point. And I saw it grow literally 100x when I was there. And then I did co-found a company and saw what it is to go from 0 to 1. So I like to think of myself as I started my career, maybe not 1 to 100, maybe that's the way to put it. And then at another point in my career, I went from 0 to 1. So I've seen that spectrum of what to do from 0 to 1 and then 1 to 100. And that's what I'm trying to bring here at Tao. Um, I think having done my own fundraise, having um, helped build a team, having um, tried to build a product out of nothing and then trying to commercialize it, I think that gives you a lot of empathy. I think that's perhaps the single biggest lesson that you learn, because if you have actually experienced the challenges of being an entrepreneur, then when you meet another entrepreneur, you know what challenges he or she is facing, or at least you can appreciate it better.
Yes, completely agree. I wanted to go into the formation of the company and what the various roles are. But before we do that, I wanted to see if you would comment about your two VC firms. What is the order of priorities? I mean, a VC firm has to raise money from limited partners. They have to find companies that are in the thesis or in the sweet spot of what they want to invest in. If you get a lead investor or a deal lead in that area, they have to go through the due diligence and decide how much, if they're going to be a lead investor and how much you want to commit. And then they have to syndicate or find some syndication partners. Is that reasonably accurate, or am I missing
No, I
something?
think it's reasonably accurate.
Okay.
And I should have mentioned this up front, Jim. Even when we were talking about the startup, I played an important role, but there were people in my co-founding team that played even more important roles and should deserve most of the credit. And I'll say likewise now about the VC fund. A VC fund is a team at the end of the day that it's very rare that it's a one person making a decision. Um, there are such things as solo VCs where literally one person is doing everything, but there's still a very small, very small minority. It's more likely that you have 2 or 3 people, 5 or 6 partners. Maybe you have a team of principals and associates, and you make a decision based on consensus. You make a decision based on what is the overall belief of the firm, with one person championing that deal. And then, especially at the early stage, you share that risk and share those opportunities with other VC funds. I think most entrepreneurs know this, but um, you want multiple VC funds invested in you. You don't want too many, you don't want too little. There is a right balance. And we can go into the details of what that balance is, but I, as a almost as a principal, when I invest at the seed stage, which is my primary focus, we want at least another VC fund in the deal with us. And if there isn't one, we actively help the founder find one.
That's partly for validation, sharing risk, and maybe a spread of expertise. Is that correct?
Absolutely, absolutely. It increases the odds of success. So if you think about it, for a startup, you want the more people are invested in your success, the more they are vested in your success.
Yeah, people will step forward to help you if you have that, if you made the connection and you've got depth. And one of the things that I have observed over time is after, and I'm getting a little ahead of myself, after an investment is made, unfortunately, too many entrepreneurs or entrepreneur teams stop the communications. If you call them, they'll say, oh yeah, this is what's going on, but they don't push communications forward. And you just mentioned how important your investor newsletter is. You have to push this out all the time. Do you counsel or coach the entrepreneurs on how to properly interact with their investment partners?
Oh, absolutely, absolutely. This is one of the big things that we do. And one of the key things with diligence also is, will the founders work well with us? Will the executive team work well with us? And we're not expecting perfection. There is no such thing as perfection, but we're looking for, is there mutual respect and there mutual trust? And can we develop this relationship further? So, on a very practical level, I advise all of our founders to have a probably quarterly newsletter. Could you do a little bit less, a little bit more? Yes, but quarterly is a very good cadence. Uh, Put everybody on that newsletter, your potential hires, your potential partners, your potential investors, and the actual ones also in all those categories. And that way you keep mind share. You can tell people what's going on. When you interact with them, they already have thought through or learned a little bit more about you. That's one way of doing a communication. Another way is to use social media effectively. Depending on the type of company you are, you may want to use um, YouTube or TikTok or Snapchat. There is a space for those companies, but oftentimes it means LinkedIn and Twitter. And we advocate very much for when they're looking to hire a company, when a company is looking to hire people, to post it on LinkedIn, to tag their investors, to create some kind of engagement online, because that's how you enlarge your reach by 10 to 100x, maybe even more than that. Um, we also counsel our startups to do events. And I know that in COVID times, it was a little challenging, but doing an end of year event this point in time is very much doable. Doing more regular events than that. One thing that we used to do actually in my own startup is once a quarter, we would invite a bunch of people to show up after our Friday all hands. And that way we could get a bunch of people to come and meet us rather than having to spend one-on-one time necessarily when you don't have it, and at the same time meet a lot of the team. So there's many creative ways of building this ecosystem around you to be stronger and stronger. And we do work very closely with our founders to do that.
Right. That's a great point. Just having those face-to-face where you get to talk, you get the sense, and it's not a, quote, formal board meeting or anything. You just build camaraderie and understanding.
Absolutely. It's mutual respect and mutual trust.
Good. Let me move in, because there's many people who will watch this who are entrepreneurs, and so there's typically gaps in their understanding of how a deal goes through. So I'd just like to take maybe a case study, if you will, minor, short term. You go,
Sure.
no, your partner goes to a event, some type of pitch event, whatever, and he finds, this is kind of an interesting company. They're in our sweet spot of area, AI or some other people. And he comes back, and the next day he says, perhaps in a staff meeting, I found a really interesting company here. They're all about the next wave of IO or life science or so on. What happens next?
Well, that case study that you mentioned happens often. And the source of that company may have been an event, may have been a tip from someone we know, an advisor, a mentor, an investor of ours, a co-investor of ours, an angel, somebody running an innovation program, an accelerator. Could be a cold call email, but there's many sources. Other VCs, very much a big source of deals. We share deals with each other all the time. But the next step is usually, let's look through the deck. Let's make sure that there's an opportunity here. Maybe they're not fundraising. Maybe they are fundraising, but the round is closed. Maybe or closing, or maybe the deal terms are too high for us or too low for us. Let's validate that this is a fit for what we look for. Oftentimes, a deal could be amazing. It's a great company, but we are not the right investors to do justice to it. And in fact, I tell founders all the time that I told myself this also, that just because an investor is saying no, they're not saying it's a bad idea. They're just saying it's not an idea for me. You may actually discover that you have an amazing idea and 99% of people will say no. That doesn't matter. You need that one person or two people to believe in it and work with them. But we look through the deck, and we usually do that before taking a meeting. There are exceptions to this if we know the person well, if it's a particularly warm introduction, or if the timing of the deal is very hurried so that we need to actually talk to them right away. But usually we'll do a first pass. And just to give some numbers here, we get 2,000 decks a year. We cannot possibly do 2,000 meetings a year. So we end up going through the decks, and about 10% of those will do a first meeting. And then usually about half of those will do a second meeting. And about half of those will do a third meeting. So if you follow the math here, we went from 2,000 to 200 to 100 to 50. And by the time they're down to 50, that's about one a month for each one of the two of us who are leading this fund. There's more people involved, but that means that at any given time, we're looking at one deal per person in a very serious way, writing a deal memo, doing extensive diligence. And that process, the output is either yes, we have conviction, we'll invest, or no, we can't get there for one reason or another. But we also have a principle here. The more time we take from an entrepreneur, the more we try to give back also. So if we are down to a third meeting with an entrepreneur and we decide not to do the deal, we'll still do something to help them. It could be an introduction to a customer. It could be an introduction to an advisor of ours. It could be an introduction or at least mentions of other potential investors. So we believe very much in pay it forward. We will end up investing in 1% of the deals we look at. We got to do the right thing for as many of the other ones as we can.
Very good. I think that's really admirable because, too many times entrepreneurs, it's a your doors open, doors closed environment or experience, and yet a venture investor can add so much value in terms of the feedback mechanism that this didn't work for us today, but here's what you might consider adjusting for other investors. Something you have a unique perspective on that, so that's excellent.
Thank you. We try to do that, Jim, but obviously we structure the conversation accordingly, right? In some cases, we want to make sure that it is the right kind of feedback and the right mindset. You don't want to tell somebody upfront that, I think your idea is completely bogus. If it is, you break that news, and more likely than not, it's not that it's completely bogus. More likely than not, it is there may be a particular challenge that we see that they don't think that is as big of a challenge. So it's usually about sales cycle, by the way, for me. Like I often bring that point up that the sales cycle here is going to be hard. How do you get 9 to 18 months down to 2 or 3 months?
That's good. Approximately how long in your environment does that process take of the after the first meeting, well, after you read the deck, you have the first meeting to the point that you've got enough due diligence and enough valuation models or buy-in from the team to, I guess, come to a term sheet offer or say we're ready to go ahead and make an offer? How long is that process?
Yeah, we have once made a decision overnight. That was because we knew the company really well. We for years, and they told us that we're closing the round. We have a little bit of room left. We're willing to share with you guys because of everything you have done for us. So that was a no-brainer. We knew the company and the founder so well. We said, let's do it. Um, that is a rare case, and that's sometimes what makes the news, right? Or used to at least. Very rare, less rare, but also rare situations is where we have a lot of understanding of the space, even though we may not know the company as well. And there's round dynamics compelling us to make a decision very quickly. So we make it within a week. That has also happened. More typical is we do a first meeting, then we'll do a second meeting, then we'll do a third meeting. We'll deep diligence through this process. We'll get to know the co-investor, the main co-investor, if there's one already in place, and we'll come up to a decision within 3 to 4 weeks. Um, and once we make a decision, once we're in, we're in. We'll do everything it takes for that company to succeed, even before we wire the money. If they need other investors, we'll share it with other investors. We'll bring it up. If they need other customers, we'll start making those introductions. It can take longer than that, especially if there's not a lead investor in place already. So what I tell founders is budget yourself for 1 to 3 months for a fundraise. It can be quicker, it can be slower. It depends on a lot of other factors.
I want to ask you another operational side. I've observed this. A lot of companies get their seed round and they wait too long to go back out and engage with the investor marketplace, not only their existing investor, but new investors. And I've always said or observed that the best rule is at least 6 months of cash flow in the bank
Agreed.
before you go out. At least. And this is minimum.
Agreed.
8 to 9
Totally
is
agree.
much better.
Totally agree. 6 months of cash in the bank and 9 to 18 months to raise the next round. Those are good rules of thumb.
So after you've made the investment now, your company's in, probably a seed round, typically a seed equity round, I take it, correct?
We're open to everything. We have done safes, we have done other types of convertible, and we have done secondaries where we bought out as long as it's preferred shares. And I can define all these terms, Jim, if needed. But the most typical round for us is an equity round. And as we speak right now, the most typical round for us is when a company is raising about 3 to 4 million. The valuation is somewhere between 12 to 18. The team is usually 6 to 7 people. The company is about 1 to 2 years old, and they're looking to raise the next round within 9 to 18 months.
Yeah, one of the big risks is not only product risk, but sales or customer risk. Will they adopt it? How much proof do you need of validation that the customers will buy this, or if it's a sufficient need in market that someone will pay for it?
Yeah, we really like late seed. So let me give a framework here. An early seed is a PowerPoint, is 2 people in a garage, call it. An early seed is a prototype. You have something to show, a little bit beyond the PowerPoint. A late seed is a pipeline, maybe pilots giving some early revenue. So you're starting to get product market fit. And a Series A is product market fit. And typically the number 1 million ARR is used as a benchmark in the US. And then Series B is your business model is kicking off. And C, D, and E, if you need it, is because you're really escalating your growth. So within that framework, we really like late seed. Occasionally we'll do early seed. Once or twice we've done a pre-seed once we knew the founders very well, or the space really well, or the co-investors really well, or all three very well. But late seed for us is when you have a pipeline of customers, and not just one. One means that you had a friend somewhere. 2 means maybe you got lucky, but 3 or more means that there's a pattern. So There's exceptions to this. We have seen companies and we have invested in companies where there was one big marquee customer, but more generally, we like to see more than two or three, and they don't need to be closed, but we try to understand how did you get to them? What is the potential contract size? Can it become a bigger contract? Can it become a recurring contract? Can you leverage it to grow other contracts? Can you cross sell or upsell? Um, do you have a sales team if there's sales involved? Or if there's no sales involved, let's say it's a consumer focused product, what are your engagement metrics? We don't expect companies to be making a lot of money at this stage, but we do expect them to be getting at least visibility among the end customers, whoever those end customers are.
Well, now the inevitable challenge comes when it's 18 months later. The company has not met their goals. If they met their goals, everything's great. We're all happy. They can raise another
Sure,
round. Valuation's up.
sure,
They haven't met their goals for
sure,
perhaps reasons beyond their control or reasons that they just failed to execute correctly.
sure, sure.
What happens in your shop? Do you say, well, some venture capital will throw money because they don't want to take the write-off. They don't want to see them go down the tubes right away. Others will say, no, you've got to do X, Y, Z, and we'll give you some more money, but the valuation might be lower. I'm sure it's an individual
Sure.
case in each situation. But
Yeah, it is. And I write a lot on LinkedIn. Jim, let me put a small plug slash share that resource. I've written a lot about this topic. Anybody who wants to take a look, I've counted, I've more than 300 articles at this point because I've been writing for years. Um, and this does come up a fair bit. What to do if the market is slow? What to do if your company is not hitting those milestones? What to do if your burn is too high? What to do if your growth is slowing down? What to do if you need to let go of people? So you have a toolkit, and that toolkit gives you all these different options, and all of these options have different consequences. But the ultimate goal should be one of these goals. One is you decide in conjunction with your major investors that maybe this company doesn't have a future, so you shut it down or you spin it out. Basically, you hit a reset button or you hit the power down button, right? That's one scenario. It happens. It's not super common in my experience because the types of companies we have found have been already vetted, but it happens. The more common scenario, much more common, 99.9% of the time, is um, the company has a promise, the idea still works, but there are fundamental things you need to improve about it. So if it is a challenge of funding, we will help them fundraise more. If it makes sense, we will find other investors. It could be a smaller up round, it could be a flat round, it could even be a down round. That is actually quite rare for us, but it can happen. Um, or you could raise venture debt if it makes sense. If you have revenues already, if you have collateral of some sorts, then you can raise debt instead of equity. You could reduce your burn rate by some ways by perhaps furloughing people, laying off people, but there's also the options of asking people to take a salary cut or exchanging equity for salary. Like we have had portfolio companies that actually themselves decided not to pay themselves anything for 3 to 6 months until they raised the next round. And they did succeed. We did help them fundraise. They actually pulled off the money and then they ended up actually being sold. I can give you that case study. It was a very successful company, actually. We have case studies for all these scenarios. And in fact, my business partner, Sanjay, has a great case study of a company that he essentially helped recap that ended up becoming the biggest moneymaker for our previous fund. Got sold for 1.6 billion. So there is such a thing as a save, right? And then the third thing is there's the scenario where you decide to shut down or recap or reset. There's a scenario where you try to recover in some ways, and there's the third scenario where you ask fundamentally, okay, um, maybe it's not a problem of substance, it's a problem of style. And if it's a style issue, then you can work with them, you can coach them. I've met founders who are brilliant, but they may not necessarily understand all the nuances of how to pitch to a VC or all the things that an investor might be looking or a corporate might be looking or to structure a joint venture or to do a partnership of sorts. So one of the benefits of working with other people, and especially other people who have been entrepreneurs and are investors, is that you have somebody else to dialogue with. And I do believe that it's the merging of ideas that creates better ideas.
we all hope that these companies move towards an exit. And I'm always interested to know from a venture investor team or a company, to the extent that you as the investor or lead or just one of the investors, do any of the investors step forward to help with the acquisition or the sale, I should say, the liquidation, the sale of the company? All too often, in my casual observance, nothing is being done proactively in many circles. And in other circles, it is being done. The investors are out looking, using their contacts. And
Oh, absolutely,
yeah,
absolutely, absolutely. I tell everyone that an acquisition is usually um, an overnight decision over the course of multiple years. Usually, almost always, an acquisition happens because you've been, let me use another analogy here. You've been dating each other for a long time before you decide to get engaged, right? Usually it's that. And investors oftentimes play an important role, not always. Sometimes you've built a relationship with a potential acquirer yourself, but oftentimes the investors help with making that connection, with helping align that connection. And I will give a very public example. This has been written off very much so. LinkedIn got acquired by Microsoft, and Reid Hoffman fundamentally played the most important role behind the scenes to make that happen. This has been written about extensively, so people can Google it up and look up what Reid Hoffman did. I can give you case studies from my current life and even previous lives where this was also the case. At the very least, what an investor can do is an investor has gone through multiple acquisitions and IPOs, usually relative to the founder. It's pretty rare for a founder to have gone through more than a handful of acquisitions in their lifetime. An investor will go through, because they have much bigger of a portfolio, through multiple ones. Like I've already gone through 4 exits in just about 3 years in my portfolio. And for a founder, that may be one every 10 years, right? So I have a lot more data points. There is an asymmetry of knowledge and experience. Founders understand their business and their market better than a VC would. But VCs understand the overall market and the overall dynamics probably much better than a founder. And if it is equal, which in some rare cases it is, I've especially founders who were investors before and investors who were founders before, sometimes there is that duality. I still find that people know different things. I do have a couple of founders in our portfolio that were VCs before. And when we talk, it's rapid fire because we both know what we're saying to each other, but we both learn from each other still, very much so, because there are things that we have done, that we have seen, that they may not have, and vice versa.
We've entered a slowdown economically speaking. And of course, the first winds, the first breeze of a slowdown in the valley makes everybody step back, at least to some extent. Yet the contrarian point of view would say, no, this is exactly the time you want to step forward as an investor. Make sure your companies are plenty of confidence that they can survive this. They can execute. They can maybe pick up key employees from other companies that are slowing down, going through that hesitation. Right now, there seems to be the mantra here is reduce your cash burn, get ready for a cold winter, something to that extent. Do you have
Well, we are in winter already. It's December 29th.
right,
Winter
right.
is here.
But do you have
Um,
an impression or an opinion about that? Look, you got to hunker down certain times, or no, you're going to be a contrarian during times that we appear to be entering.
so I will tell you my own belief of what we're doing here at Tao. Both Sanjay, my co-founder, and I, alongside the other people in our team, are more bullish about investing. We were more active this year than before, and we expect it to be more active next year because we have the cash, and we also believe that when less people are taking a step forward, is the time to buy, is the time to do more things. So I'm speaking from an investor's perspective. I remain very bullish about what's going to happen, not right now, but in the near future. For me, a downturn in some ways allows me to do more with my money because valuations have come down, amounts raised have come down, less people are investing, so I can do more. The flip side of this is obviously from a founder's perspective. You need to be more careful for sure about how you manage cash. And we worked with all of our portfolio companies to make sure that they had at least a year, not even 6 months, but a year of cash. Sometimes it entailed raising debt, sometimes raising equity, sometimes getting some early, recognizing revenue earlier, letting go of some projects that were longer term, perhaps rearranging the team in some ways. But we actively worked so that 95% of our portfolio is in that situation. And it does affect fundraising for everyone. So if founders are thinking that um, only they're affected. That's not true. VCs are also affected in terms of us being able to draw capital from our own LPs, because LPs are being much more mindful on what they invest in. So a downturn, though, overall is not a bad news. It certainly causes distress. It certainly will cause companies to fail. It certainly is painful. But if you look at all the great companies, most of them have actually been created in downturns. Google, very famously, aggregated a whole bunch of talent because of a downturn. PayPal survived a downturn. And look, I think there's something to be said about the PayPal mafia being so good and so connected because they survived a really very challenging environment. It made them more resilient. Um, if you look at Microsoft, if you look even at Apple and Amazon to a certain degree, they are products of downturns. They may not have been created in a downturn, but they really, really aggregated more talent. There's more good people available. They aggregate. If you survive, you will thrive. And I think the history shows that um, those who are willing to take a risk in times that are riskier actually end up reaping even bigger rewards.
I just have two last topics, and I want to just touch base. So, because a lot of entrepreneurs do not understand the obligations or the limited partner relationship that you have to build to have money to invest. And I thought you'd just talk about you get a commitment from a limited partner. First of all, you have to go out and meet a whole bunch of people. And you told me before we started,
About 1,000 people. That's what it takes.
1,000 people. And then you're going to get some population that says, we'll go ahead and we're going to place some money with you.
5% will end up actually committing.
5%. Okay.
About.
And that's,
Yeah.
I estimate, maybe a 10-year fund. Is that right?
Those are 10-year funds, and different funds will call money differently. There are funds who will call everything up front. I'm probably on the other end of the spectrum. I call money very slowly, 10 to 15% on average. And I also return money much earlier because that's an advantage that a small fund has. Um, I have exits and IPOs, but I also have a secondary, meaning I can sell my own shares in a company to somebody else, to another fund. Once a company is maybe a series B or a C, different funds, bigger funds will want a piece in, and I have an opportunity cost. But the obligation that I have to my LP is I can't promise that I'll make money. Obviously, nobody can promise that. But my obligation is that I'll work very hard to make that true. And the way you structure a VC fund is 2 and 20. So 2% of the fund is used to run the fund. 20% of the profits of the fund come to the people running the fund. 80% go to your LPs. So I'll come up with a very easy example here. Let's say I invested $1 million into a company and it was worth 5 million, let's say, and assume there's no more money that went in, nothing else happened, but the company succeeded, it grew, and eventually got sold for 100 million, right? So I'm making up an example,
Sure.
very simple one,
Yeah.
but I had 20% of that company, right? 1 out of 5 is 20%. 1 out of 5 post valuation. So when it's 100, I have effectively 20 million. So of that 20 million, I'll send 1 million back because that's the principal that was used to invest it in the company. I'm left with the 19 million. Out of that 19 million, I'll take 80% and I will send it back. And if I'm doing my math correctly, that will be 15.2 million, and I will be left with 3.8 million. And those are the profits that we as a firm will make on this particular deal. Now, I'm simplifying it hugely. There's management fees, there's different things that may have happened, there's liquidation stacks, preference stacks, etc. But overall, this example holds true.
Mm-hmm. That's very good. That's the next example. You did it very articulately and clearly. So thanks for doing that. That's great. The other elephant in every entrepreneur's room is valuation. And there's lots of discussion about how do you get the valuation right. Many people or many entrepreneurs seem to come out of a accelerator and have an unrealistic high valuation. And I've seen people say, look, pick a number. If you're too low, you're probably going to learn that pretty quickly. Someone's going to tell you you're going to have competing bids. If you get too high, you really run the risk of people just turning away and saying, no, it's not in my profile. What are your thoughts about the valuation for entrepreneurs?
Well, I think valuation gets overexposed, meaning we pay, all of us, VCs, founders, media, etc., all of us pay so much attention to valuation, um, in detriment to everything else that is structured around a company. Is valuation important? Absolutely. Is it the single most important thing about how you structure a deal? Perhaps, arguably, but it's by no means the only one. Um, and uh, Too high of a valuation too early is as bad as too low. Because too low, I think people understand. Too low means that you give up too much of your company. But too high means that you set the bar too high. You have to really, really over execute to beat that in the next round. And it could end up hurting you. You could have a flat round or a down round, or maybe it's an up round that's not as strong. What you want to show is momentum. You want to show that you're continuously growing. And I have a very, very rough back of the envelope guideline here. You want to be raising roughly every 9 to 18 months, roughly at every doubling your valuation at every round. Um, and you also, here's another framework. At the first institutional round, meaning the seed round, when you're getting money from VCs, you want to give up somewhere between 15 to 25% of the company. So 20% is the median. So 20% of the company goes to the investors. Same thing for the Series A. Series B, you can argue for a little bit less dilution, maybe 10 to 15%. Series C, you can argue for 10%. And where these numbers come from is actually, if you look at data inherently, it's the risk reward that's inherent in a company. So let's do the math here as an example. If I'm raising 1 million at a seed raise, I'm probably the VC is probably expecting something like 5 million in terms of evaluation. It could be a cap of 5 million if you use the cap as a proxy for valuation. It could be a price round of 5 million post, right? Can it be a little higher because you are a very proven founder? Sure. Can it be a little higher because you have had exits and you have traction? Sure. But then you have to be able to justify all of that. Then let's say from this 5 million post, you grew the company, you did very well, and now you want to raise 4 million. And I would argue that if 4 million at 20 or 25, somewhere between that range as a post valuation, that's pretty reasonable. Now, these numbers are anybody from Silicon Valley who's listening to these numbers is probably guffawing. They'll probably say these numbers are too low. And you're right, they may be too low for Silicon Valley, but the ratios are actually pretty constant. The deals in other ecosystems, a lot of them in the Midwest and East Coast, they actually have these numbers that I'm mentioning. And in Silicon Valley, the numbers might be 20, 30, 40, 50% higher than that, but the ratios are something I would argue relatively constant across different ecosystems, at least in the US.
Well, one of the other things too is I forgot to mention this earlier, but your broad involvement of the international community. You've got investments all over the world. You yourself have a background in Brazil. Can you talk a little bit about that just so our audience can be aware of that?
Thanks, Jim. I appreciate it. Yeah, I'm born and raised in Brazil. Immigrated to the US for college. So just about half of my life in Brazil, half of my life here in the US, a little bit more. Guess I'm dating myself. And I have spent time in India, which is where my roots are. My family came from there. I do speak the language Hindi, the most spoken language. Um, so I'm proud to be fluent natively in Portuguese, Hindi, and English. I can handle a few other languages. And I am active in those ecosystems in multiple ways. So Tao is investing in the US. 99% of our capital is invested in the US, but very opportunistically, we're open to investing in a handful of geographies outside that we know well. So Brazil and India as being obvious spots, but also Canada, Singapore. We have raised 25% of our capital from Singapore. We go there at least once a year. Maybe UK, since we understand that ecosystem reasonably well. But the flip side of this is that I have invested in 4 companies in Brazil, but the flip side of this is we have raised money from many parts of the world. In fact, I counted this. We have 18 countries besides the US that are represented in our LP base. So LPs that are living in 18 other countries. There's a big concentration from Brazil, from India, and from Singapore, but I have tried to build ties and bridges with many other parts of the world. And that's, I think, very beneficial on a number of factors. It helps us understand what else is going on in the world so we can help our portfolio companies. It helps our portfolio companies eventually expand internationally. Sometimes they use a smaller country as a go-to-market, test out their ideas before bringing to the US. And I think what we provide in terms of knowledge, understanding, trends, we can help other ecosystems also leverage those. So I would like to think that we're creating bridges globally. I think we are a US based, US focused venture fund, but doesn't mean that we are unaware of what else is going on in a much, much bigger world.
Very good. Well, I mean, you've been excellent. I really enjoyed you answering in such detail my questions. Many people don't have the ability to do that. So you've been very, very generous with the details that aren't always, people don't always want to share. Is there contact information you'd like to give either to entrepreneurs or frankly, even to potential investors?
Sure, Jim, thank you for the kind words. Really appreciate being here. And thank you to all of you listening. And if you want to get in touch with us, uh, best way is to find a warm introduction. I'm looking at you, Jim. So that's one way. If you don't have any other ways of getting to us, then send us a note. We're on LinkedIn. Um, we read through every single message that hits us. We may not be able to respond to everything, but rest assured, if it is a fit, if there is a possibility of doing something, we will follow up. Um, if you are a founder specifically, then send us a deck. Send us whatever you can share. Um, I get a lot of pings saying, "Hey, I'm building a business. Let's chat." I go like, "Well, that doesn't tell me anything. Tell me what you're building. Look up what we do. If you're doing healthcare AI, enterprise AI, then we may be a fit. If you're doing something else, we're probably not fits." And if you are somebody looking to potentially invest in VC funds, definitely reach out. We've had a number of people reach out. We're closing on a new fund as we speak. So happy to engage, happy to build relationships. We're looking to build a community around us, and very proud that we have 1.6 million followers at this point in all the different channels that we have. So we want to keep enlarging that.
Good. Well, I think the LinkedIn connection is Tau Ventures. Is that correct? Or is
Tau
it?
Ventures, and then Amit, Amit, Garg, Garg, that's my name. It's also on the screen. Then Sanjay is Sanjay, Sanjy. Rao, Rao. We're on the websites. I mean, if you're a founder, you can probably Google us and figure all this out, which is probably a litmus test for hustle.
Yeah, we always respect hustle. That's for sure.
We do. You have to have it. It's necessary, but not sufficient. But it's absolutely necessary.
Well, I mean, I want to thank you so much. I want to wish you a happy new year. I want to wish you every success going forward.
Thank you. Same.
Thanks for joining us in this podcast. If you find this conversation insightful, share it with your network, and yes, become a subscriber. You can find us on your podcast app by searching for Game Changers Silicon Valley. We look forward to your continued interest in upcoming shows.